All right, so we're going to take a look at the quarterly market trends. So, starting with large cap versus small cap, on the quarterly market trend review, we'll do this quarterly, and we're going to be looking at large cap versus small cap, factor trends, growth versus value. So that's kind of a drill down. Emerging markets versus U.S. markets, uh, commodities versus the S&P 500, and sectors versus the S&P 500. They kind of rhyme with the emerging markets versus the U.S. markets. So we'll take a look first at the large cap versus small cap, and that's shown right here. Removing this, we could get a better idea, and removing the last year high and low, just kind of bringing down the noise of all the lines here. And from here, we could see the quarterly resistance, and then the quarterly support, and the range lines it put in, and then quarterly support here. This would be the invalidation of this signal of the pattern of the cup and handle, because if we close below here, it's a sign of weakness versus the sign of strength it's producing. And the conclusion is that large cap is trending over small cap, and that's shown by the cup and handle pattern. Cup and handle pattern is a bullish move or pattern, and basically all these bears are wrong, and it's getting ready to it reclaimed. It broke down, but then it reclaimed. So it's basically saying that there's a lot of strength against the bears, and the bears in this is the small cap. If the small cap gains strength, it would go down, but if it goes up, it's the large cap that's got a lot of strength, and that's what it's showing right now. It's kind of making a bull flag, and we would expect it to go higher. And the question is how high, and we would forecast with this range, and it looks like we could go roughly, if we were to measure by percentage on the pair, another 20% to the upside. We do have quarterly resistance. We've tapped it once, but the next quarterly resistance would be up here, and it looks like it would be in that zone of 20% to the upside for large cap. And if we go down here into another version of it, the Dow small cap versus the S&P 500, we're seeing the same pattern, cup and handle, and strength on the bulls for the large cap. On the pair, if it goes up, it's indicating the large cap is winning. If it goes down, it's indicating the small cap is winning. But this quarterly candle here broke out above resistance due to this candle close on the up bar, and it retest, and it's basically consolidating here, and it's holding on the previous quarter's support, and it looks like it's going to want to come into the fake out zone, which is roughly probably 20%. So that we do have more upside for large cap, but it's basically saying large cap is trending over small cap. So that will continue until that 20% is filled. So that concludes that. Factor trends. So factors are something like value, growth, quality, and low vol. And I like to put it in a formula. One factor trend is basically quality versus growth, and right now it's saying that it's kind of in a no man's land. And we could see based on the trend channel that there's a relationship, and we're kind of below the middle, but at the same time we're not really at a good spot to buy. A good spot to buy would be here, and I got those green levels because of the 6 month. The 6 month breaker that we retested and resumed off of. This would still be a good level to buy at because it's near 6 month demand. 6 month demand is the close of the down candle on the 6 month. And when I superimpose that on the quarterly, it happens to be at a really good bottom area for the moving average channel, ascending moving average channel bottom. And that's where I would buy quality. Right now I'm saying quality is still overpriced compared when compared to the S&P 500. So when I look at that, I would say that right now SPY is greater than Q in the factor trends. It's trending better than the Qs, that's the SPYs. And that can be seen by the breakdown in the moving average channel. The one thing that hasn't broken down here is this moving average channel on the 6 month. But we'll find out on 6 months, within 6 months, if this is able to hold. And we're not sure. But there's a good chance that we're underneath it. This is resistance here. And we could come up here to test. And if we get a rejection, most likely we're going to want to come down to the demand, the quarterly demand. So I would say if we were to just draw a trend line, I'd say we're SPYs beating the Qs in a short term. And that also rhymes with the formula of quality and low vol versus value and growth. So growth is represented by the Qs, quality is represented by the SPY. If we look at the formula of value versus growth, so value and growth combined divided by quality and low vol combined. And when it goes down, it's basically saying that quality and low vol is winning. And we put a fib, I don't know what maybe put a fib there, but if we get the swing pivot high and low, so we got pretty much the swing pivot high correct. If we were to be exact, it's right there. I think it was based upon the week or the month. Let's try the month. Maybe it's the week. So we adjusted it for this swing pivot high, and if we were to get rid of the fib on the week, we got a range put in already for a swing high and low. So that's how we got that swing high and low. And we go back to the quarterly, we're able to see, okay, the fake out zone is here. We want price to go in here to buy. So we would not get excited about growth and value until we get here. So that jives really well with the Q and SPY. We want that to go lower. We want it to go down into here. So that has a lot of confluence with what this is saying with quarterly demand, with the Fibonacci fake out, where we would want it to go to get oversold conditions for a really good place to buy quality and value and growth. So right now we're saying that quality and low vol is trending. It's doing better than value and growth, and we want it so that value and growth grows weaker and weaker until it gets here to buy. And it's right now not profitable to buy value and growth. It's profitable just to hold quality and low vol, and that trend is something that we see right now. Value versus growth, we don't really need to look at it, but for the most part, it's just kind of going sideways. There is a little strength in comparison of value versus growth, but just as we said here, we want it to get worse for us to have a better place to buy, a lower cost basis. And in order for that to happen, we need it to flush out, and it hasn't reached there yet. Emerging markets versus U.S. markets. So that is determined. I don't think we have it up here yet. I need to put it in here. Go to the bottom. I think I put it in here. I did not. So the ES divided by MSCI. I'll kind of copy that, put it in. Okay. Oh shoot. I hit a button, extra button. There it is. I don't know where it added it, but it was definitely not the bottom. Okay, we're gonna have to just do that. So here I put a fib on the quarterly swing low, and attach it to the swing low here, put a fib, and it's confirming kind of what we're seeing. So we were to take it away and isolate my explanation, what we see is that a deviation, a breakout for a reclaim, a retest, and a failure on the retest. It actually closed below and it's going deeper. And we expect it to come and test these lows and partially see it failing to hold and go deeper. And this makes sense with an increase in commodity prices, an increase in performance in commodity prices. If we continue to go lower, it means that emerging markets would do better than the United States stocks. And what we know about emerging markets, the stocks outside the US have a lot of commodities. So that makes sense with kind of what we see. And we would see that showing in the sectors of the S&P 500, SP, the XLE, XLU, XLB. So those are materials and energy. So we would see that, and we do. And then we would also see it in comparison of DBC, commodities ETF, versus the S&P 500, and we do. We see strength in commodities. So this makes sense that emerging markets would outperform the S&P 500 in the coming days. It's not yet invalidated that it will, but it's looking like it's heading that direction. So I put here that MSCI is trending over the S&P 500 due to our relationship that we see in commodities. Next, we'll go to the S&P 500 versus the sectors. So we would look just briefly. This is the S&P 500 sector ETF divided by the ES futures S&P 500. And what we see, we want to put it to the strictest standard and just kind of a trend, and it's the 6 month with the 10-period moving average channel, high and low. And we see it close the 6 month above moving average channel high. So energy is a really good contender for more upward trend because it looks so strong on the close. Above, the strength is determined by where it closes in relation to the moving average channel high and low on the bands, the yellow and the orange and blue bands. And energy and healthcare were the only ones to have a strong close above the S&P, the moving average channel high. Now this healthcare looks a little unsure. I don't know. It looks weird. The pattern, a nice bull flag, and it kind of broke out, but it looks like a retest. I don't know if it's gonna spike up really high, but it could. It has that potential, but it also could be a deviation and come down lower. So I'm unsure about healthcare, but it looks like with our rules about a close above the moving average channel high and the previous 6 months, it's been moving really strong. Now we have to wait. I would say I would wait on healthcare, but energy looks good. I do see like a retest coming, a pullback coming in for energy, with that long expected, what's it called, recession thing. But, after that's flushed it out, I'm really bullish oil. And this is discretionary. Doesn't look that good. I know we're at the lows. Nice kind of pump on reclaim. But, out of all of these, we closed below the 6 month moving average channel. It doesn't look good. I don't know. I wouldn't bet on the trend of discretionary. Materials, it hasn't closed the 6 month above the moving average channel high yet. And tech, it's starting to go into the moving average channel, which is not good. It's a sign of weakness and possible reversal to the downside. We don't know yet. We have to see it play out 6 months, but it's not looking good. Energy and healthcare looks good. Strong close of the 6 month over the moving average channel 10 period high. So that is the conclusion of that kind of market trend of review. Now, commodities versus the S&P 500, we kind of gave a revealed our hand, but it's true. Like, commodities look great against the S&P 500 if we can find it. DBC versus the ES, and we remove the last year high and low. This is what we see. We see that we had a strong 6-month close above the moving average channel 10 period high and low. We closed above resistance on the 6-month. Resistance was here. And due to this 6-month candle close, now it's time to retest. And then once we resume out of it, we would see commodities do really well. Right now, we're kind of just bull flag. We're making a bull flag. This gap down is a little bit something where we need to see if it can reclaim to the upside. But this would be our invalidation. If we close the 6-month below this support here to where it can't hold this area for the deviation and it comes back below, then I would say that's weakness. But right now, it looks like commodities look strong and could allude to a second leg of inflation. And also, China reopening could allude to a second leg of inflation indirectly. So, in conclusion of what we see of the trends is that we see that whether it's commodities versus the S&P 500, the sectors versus the S&P 500, or sectors versus the S&P 500, or sectors versus sectors, the emerging markets, MSCI versus the S&P 500, value versus growth, and SPY versus the tech or growth, large cap versus small cap. It's largely risk off, quality, value driven, and commodity driven. So that's what I would say is the conclusion of the trends. These are just kind of the macro trends, but it's largely commodity and energy driven trends that are large cap. If I were to kind of combine it all, and could be related to companies outside the United States. Metals and mining, materials, they're doing really well. That's something that's really big in Australia and China, but that's kind of just what I see based upon with the charts that we looked at of large cap, small cap factor trends, growth versus value trend, emerging markets versus U.S. market sectors versus the S&P 500, and commodities versus the S&P 500. And then lastly, all we need to look at is roughly the thematic portfolio overview. And it also kind of mimics what we see here. For example, healthcare is something that looks good here. And it also, the aging population thematic portfolio looks good. Defense, U.S. defense looks good, and that relates to commodities and materials and value-based stocks like Boeing or Lockheed Martin. So those trends look like they're a good 10-year plus portfolio that could be made. That's what I see. Right now, I expect weakness in tech to continue. I don't know for how long. I think we would need to wait until 2024, 2020 to 2026 to really see the flush out of that weakness to be put in demand for growth in tech. It's just the outlook doesn't look that good over the next couple 1 or 2 years. So we need to wait for it to flush out. But that's kind of what I see. Not financial advice, just entertainment purposes only. Because I'm in a competition, so this is more for me than it is for you. But I like to make good presentations on just my research and findings. So that's what I see. Thanks for watching. See you next video.